We are back with our feature guest, Diana Avigdor, head of trading and Barometer Capital Management. All right, we got the Bank of Canada this week. We don't have the big media conference, the monetary policy report. We do have a rate decision, and that hasn't stopped them earlier this year. They didn't wait for a meeting when they bought in one of those rate hikes. So what can we expect this week?
It's so true, actually. They've been least, how shall I say this? They've managed expectations a lot differently than some other central bankers. The last two rate increases have not been expected by the market, to say the least, and the Canadian dollar acting accordingly. I think that this time, and I say it with a grain of salt because we've been, we've said one thing and Bank of Canada did another because expectations are managed differently. The street and the market in Canada doesn't expect any rates change tomorrow. The data, especially as of last Friday on the employment side, has been great in Canada. So we think that Mr. Poloz will probably say something about that and acknowledge that some of the data has been positive. It seems, though, that Bank of Canada maybe is going to be lockstep in with the Fed, and only insofar as to keep the rate differential the same, which then keeps our currency relative to the U.S. pretty stable. Bottom line, nothing's really expected tomorrow with the exception of the acknowledgement that we're doing okay. We have a housing market that has dipped somewhat. Our financials have reported decent numbers, however, so it's a bit of a balance thing.
It seems from Governor Poloz, too, when they seemed that they were being so aggressive in the two rate hikes back-to-back this year, and then he simply came out afterwards and said, all we did was take the insurance off the table. That's what they called it when they cut twice after the oil crash. They said, this is our insurance policy.
Exactly.
We're past the worst in oil. Insurance is off the table. Now I guess it's just sort of anyone's game in terms of when they have to go again.
Exactly. And so, it makes sense that with the U.S. Doing what they're doing and our largest trading partner and where we are in the growth range, Canada versus U.S. kind of the same, that they would go lockstep at this point.
Now, our central bank, the Fed over in Europe, how much might they get ensnared in this idea that they need to get some dry powder for the next recession? We're almost 10 years out of the last one, and 9 years, and rates are still very low. I mean, only 1% in this country. How much do they need to sort of ratchet them back up so they can get ready for the next one?
So I had an interesting conversation with a currency trader at one of the banks today, and Europe, there's a lot of countries outside of U.S. That are more behind in the rate and QE situation. So the ECB is at -4 overnight rate. So there are some countries out there that are still negative. So it's entirely possible that North America will not be the leader in the hiking of the rates. And it has to do with a lot of the QE that's going on. Europe is still doing QE as we speak and will continue, according to what Mr. Draghi said, in the near future. I think he said mid to end 2018. So they'd have to taper that off before they can start raising rates. And so if the currency markets and interest rates globally have something to do with the differential, U.S. is already one of the higher yielding currencies out there. So the world has a lot more hiking to do to catch up.
I had an interesting conversation earlier in the show with one of our guests talking about the tax cut plan in the States and saying that at this point of the economic cycle in the States, if you bring in the stimulative cuts, which they are hoped to be, at least the Republicans hope they'll be stimulative, then you're going to force the Fed's hand. Because if you have an economy that's already going pretty well this late in the cycle, you put this big rush of stimulus in the end, the Fed will have no choice but to chase higher rates.
Well, would the tapering of the QE and the normalization of balance sheet not be a de facto tightening? And on the flip side, you have tax reform that may actually increase the deficit by $1 trillion. So
yeah, that's no small number, is it?
Unless growth happens to be higher than what is calculated inside that leverage effect. That'll work to sort of balance things out a little bit from an inflation perspective and a U.S. dollar perspective. One pushes up the dollar, the other one tapers the dollar. We know Trump likes a weaker dollar. So we'll see how that actually plays out.
Now, you mentioned earlier that you liked financials, but you still like tech. Tech's been taking a bit of a beating. As you go into 2018, can we expect much from technology, or would you start lessening your position there?
This is a bit of a classic situation. You are able today to, without taking the risk of a small cap company, actually get yourself returns that are very decent. You're looking at a company like Microsoft. If you look at the chart of Microsoft skirting new highs, you have a company this large giving you this kind of return is fantastic. You're not taking much risk on the company. You have, the cloud business is new, relatively speaking, a $200 billion business right now, of which they're at $20 billion and 20% of their annual revenues, which were $100 billion as of the last quarter. So you have a lot of ideas and novelty in an old company that's very well capitalized.
Is that one of the ideas that you're actually invested in, Microsoft?
Yeah, Microsoft is one of our top holdings. You have cloud margins at almost 60%. This is an old business coming up with new things and new ways to provide revenue and growth and margins outside the old business of PCs and tablets and so forth. Not only that, they're also transitioning from traditional software sales to a subscription model, which makes their revenues more lucrative. And lots of cost cutting still to come. So I think what I'm trying to say here is that there's so many positives to such a large established company. You don't have to be in tech and take the chance on a small business that maybe has no revenue, or maybe it's just a concept.
All right. Always a pleasure having you here, Diana.
Thanks for having me.
It was Diana Avigdor, Head of Trading at Barometer Capital Management.